failure. The possible causes of the failure of economic policy this century are either bad luck, bad management, or bad theory. And I'm going to explain why I think the cause must clearly be bad theory, and therefore why we must change it. Thank you. Slide 2. Examples of bad success, of deep failure this century, are slow growth with deep recessions, asset bubbles and financial crises, and rapid inflation. Output in this century has barely grown. We've had the deepest, most sustained recession since the slump of the 1930s. This was due to an asset bubble, which, like 1929, was followed by a financial crisis. Today, the conditions are ripe for another financial crisis. We can't blame bad luck. We can't blame bad luck because rapid inflation predates Putin's invasion, and the economy was stagnant long before COVID. Slide 3, please. Can we blame the management?
Bring back
sorry, I get somebody interrupting. I'll stop if I want. No, I'll continue. Can we blame the management? Only if policymakers have a sound theory to follow and the right policy instruments to use. Today they have neither. I remarked that in the 18th century, doctors are said to have killed more patients than disease. The fault was not the incompetence of the doctors, it was the application of bad theory. We have a similar problem with economics today. Slide 4, please. A central issue in today about the economics is whether we are living in a world with one equilibrium or several. That we live in an economy with a single equilibrium is the consensus model's view, and it's wrong-headed. We have 3, not 1. The consensus model ignores both asset bubbles and money supply. Controlling demand, which is what the consensus model thinks is all that matters, is not enough. We must also avoid asset bubbles, which cause financial crises, an excess money supply, which causes inflation, even when current demand is not excessive. And we've seen that very clearly in recent years. Next slide, please. Now, this is an important point here about the source of the error in the consensus model. It's not the logic of the consensus model which is wrong, but errors lie in the assumptions. The consensus model is based on 3 key assumptions. If they were correct, it would be simple to manage the economy. Because they are wrong, we have a problem. Wrong assumptions bring wrong conclusions almost invariably, and certainly in this case. We do not have a simple single equilibrium economy. Now, it's important that you should know that I'm not alone in saying this. Skepticism about the single equilibrium assumption is widespread and includes such eminent economists as Nobel laureate George Akerlof and Yale professor Ricardo Caballero. And anybody who wants the references to that can please email me and I'll give you the references of the papers they produced showing this. Bad theory almost invariably leads to bad practice, and it's doing so at the moment. Slide 6, please. Now, if you're going to have a model, you must have a model which is testable and tested. The consensus model was invented before it could be tested. We now have the data, and they show that the consensus model is wrong. It must therefore be replaced by a better model. The basic assumptions of the current model were made in the 1950s when they were not tested because there was simply no data then to test them. I was then an undergraduate in Cambridge, and some dons, notably Nicky Calder and Robin Maris, even then thought that that the assumptions were unscientific and wrong. And again, anybody who wants the reference to their papers, please email me and I'll send them to you. Unfortunately, their well-justified criticisms, which we now know to be incorrect, were ignored. And this has proved to be an extremely grave error. Slide 7, please. The key mistakes which the consensus model makes are: 1, it assumes wrongly that short-term interest rates, bond yields, and equity returns are related. They are not. Secondly, it assumes that investment rises and falls with short-term interest rates. It does not. And thirdly, which follows largely from the second point, companies do not do what is known as profit maximization. Profit maximization is the assumption that companies invest because they act in the same way as shareholders, and shareholders assumed to follow their interests being in the net worth of companies, not stock market valuation. I have never, in my years as working in the financial services industry, never met anybody who believes that that second assumption can possibly be correct. It is quite clear that shareholders and company managements worry about the share prices, not about net worth. Now, I showed all these mistakes in my book called The Economics of the Stock Market, but I am again far from alone. In addition to the doubts of Akerlof and Caballero, Ray Fair has shown that investment does not rise and fall with short-term real interest rates. He shows that, if anything, there's a stronger connection with nominal rates, and that fits beautifully with the model I will be putting forward in place of the consensus model. And James Mitchell has shown that the consensus model is falsified even it assumes that equities rise and fall in both yields and returns, and prices and returns with short-term interest rates. So we have quite definite evidence that, unfortunately, the consensus model is making serious mistakes. Slide 8, please. Now, I've called this "always keep a hold of nurse" after the famous rhyme by Hilaire Belloc. Policy must be based on some theory. And in fact, you can't really expect central bankers to go off on individual theories. Policy's got to be based on a generally accepted theory. The consensus model is invalid for this purpose. I propose, therefore, that we should use the stock market model. But I add to that the essential condition that we also take a pragmatic view about money supply. We must replace the consensus model, and it is not only desirable, essential, that its replacement must be testable and robust when tested. And my proposition is that I can show that that is true with the stock market model. Slide 9, please. Now, here I'm seeking to show that, as we can see from the chart, money supply rose steadily from 2000 to 2020. That's money supply relative to GDP. But there was no change in the trend growth of inflation, the trend rate of inflation. In fact, if anything, it was tending slightly down. Things, however, changed dramatically in 2020 when they reached through about 60% of GDP, the ratio of M2. It then roared up, and later there was a sharp increase in inflation. Now, this increase in inflation came after the rise in money supply, and it preceded Putin's invasion of Ukraine. It is clear evidence, I think, that although money supply and inflation, the relationship between the two of them is, as I can find, has no robust, testable relationship that people can find. But if we do allow inflation, we do allow money supply to grow faster than about 60%, beyond the 60% of GDP level, we are in grave danger of having a bout of inflation which is not related to excess current demand, but simply to excess money. And we can stop that, as I will show. So I'm adding to the need to replace the consensus model by the stock market model, with the need also to restrain the growth of money supply at around 60% of GDP and no more. On slide 10, please, I'm going to turn to the importance of testability. Now, economics will be a nonsense unless it's a science. We are seeking to pursue the truth, and we pursue the truth scientifically. It must therefore follow science as defined by Karl Popper, which means that its assumptions must be testable and robust when tested. The key to this, key difference between the consensus model and the stock market model is that the return on equity, which I'm showing in slide 10, the return on equity is the key that we must look at here. Slide 10, please. Slide 11, thank you. What this shows is very clear. What I've got done here is shown the annual returns on the stock market for, we've now got 220 years of data. And as I'm using log returns, the average means that the fall and the rise are equal. And you can then test for mean reversion. Mean reversion, by the way, can never be proved. It can only be tested as probable. And a very simple and much easier way of testing for this than augmented Dickey-Fuller tests is the one I do here. You simply track the trend against the average, and you can see they are, for all intents and purposes, identical. The evidence in favor of the mean reversion of real returns on equity is therefore overwhelming, and it is the basic assumption of the stock market theory. If we move to chart 12, slide 12, I'm sorry, slide 12, please. If you choose slide 12, one great advantage of mean reversion of returns, it means you can value the market. Basically, if market returns are mean reverting, when they're high, returns are high. When the market is cheap, future returns are high. When the market is cheap, they are low when the market is expensive. And by tracking past returns, we can therefore value the stock market. And it so happens that what we've got is you can value it. You can also work out from it, for example, what the return and cost of equity as any one year is. For example, the stock market is currently about twice overpriced. It gives a long-term return of 6.7. We can therefore know that, roughly speaking, the real return that we can look forward to on an infinite time horizon is 3.35% from the stock market. And that is the current cost. And it is that cost which determines the way people invest. Okay, now turning, therefore, we can use the ability to work out the cost of equity to calculate the cost of capital, and I do this in slide 13. We know at any one time the cost of equity. We know the cost of short-term debt and long-term bonds. We know the proportion of each of these that companies use. In America, that's shown in the Z1 B103 statistics. So we can calculate the cost of capital. Now, the key assumption of consensus theory depends on the cost of capital rising and falling with short-term interest rates. That did not used to be a testable hypothesis. It now is, and we can test it and show that it is wrong. Slide 14, people. Now, things that can go wrong, therefore, are not just one. There are three. Demand may be too strong or too weak. Money supply may grow too fast or too slowly. Asset prices may be too high or too low. Good management, if the economy is well managed, good management would produce growth accompanied by low and stable inflation. This requires good management of demand, money supply, and asset prices. Bad theory has led to failure. Good policy must therefore be based on good theory. Now, this leads me in slide 15 to an absolute crucial point about how we could do that. As we have three separate possible disequilibria, we cannot possibly manage things unless we have three separate control mechanisms. And I propose that in addition to interest rates controlled by central banks, which already exists, budget deficits controlled by government, which already exists, we add tax policy, which is controlled by governments. Tax policy is not the same as fiscal policy. Tax policy consists, as I will show, of shifting tax rates away from investment and put them onto consumption, so that we have a boost to the economy independent of the levels of budget deficits or interest rates. This I will show, interestingly, in chart 16. The key chart for this ability to use tax policies here. What I've done here is to add to the chart of annual returns from equity, which are shown here, not in log forms, but in actual forms, so that I can compare them directly with the level of corporation tax. The level of corporation tax is, I think, on the right-hand side, and the returns on equity on the left. And as you can see, they are absolutely unrelated. Corporation tax does not, as is widely assumed, have any impact on the return to shareholders. Shareholders are completely indifferent to the return to the level of corporation tax. What happens, in fact, is quite simple. Corporation tax is a tax on corporate cash flow, and profits are unaffected by it because the depreciation charge changes with the level of corporation tax. The reason for that is depreciation is a function of the rate at which real wages grow, and if you don't invest, you don't get much growth of real wages. So if you tax investment, you reduce corporate cash flow, but you also reduce depreciation by an exactly similar amount. The result is, therefore, that we can use tax policy to stimulate the economy, and we do this by cutting the taxes on investment, which is corporation tax, or by increasing the subsidy on it, which is credits for investment, which I think actually would work at the moment more effectively. And thereby we can boost the economy. And we can do so without increasing the budget deficit if we increase the taxes on consumption. Okay, now 17, therefore, is going to show where we are at the moment. Keynes's revolution has been incomplete. He showed that ultra-low interest rates cannot stop slumps, and that therefore the budget deficits were needed. But he assumed basically that the loss of the animal spirits of entrepreneurs, which caused the occasional problem in which interest rates couldn't stop slumps, was a purely temporary cyclical effect. And we are faced with a different problem because large budget deficits simply can't be permanent. You cannot go on having a policy which leads to ever rising budget deficits, which basically is the trend which we've had this century. And we can go on some while before it crashes, but as Liz Truss's absurd budget estimates tried to do, even after a while, you can have a big risk that financial markets will cotton on and you'll have another major crisis on your hands. The problem is, therefore, that we have a structural, not simply a cyclical liquidity trap. Okay, let me turn into slide 18, which takes this point. We have now strong proof that liquidity traps, which used to be assumed to be short-lived and therefore cyclical, can be structural, semi-permanent, and our experience in the 21st century is that this is sadly true. We cannot therefore use jet to GDP as an ever-rising way of solving this problem, and it's also one where demand does not respond to cut in short-term interest rates. If we are going to avoid an ever-rising problem from our structural liquidity trap, we need to manage demand in another way. In slide 19, I'm going to say how quite simply this is. Subsidizing investment by cost raises investment by more than the cost. The reason for that is that when you actually boost investment, you increase the proportion of GDP which has to be depreciated more. It rises because as you boost the growth of the economy, you boost the growth of real wages, which therefore increases depreciation as a ratio of GDP. The result is that you can increase.
We've got captured already, send Warner. That's just.
The result is that you can shift demand upwards without any change in the budget deficit by shifting taxes onto consumption and away from investment. Tax policy can thus manage demand. Somebody wants me to explain what a liquidity trap is. Okay, I will do. A liquidity trap is the explanation that Keynes produced. It's the word he used or the phrase he used to explain why in certain circumstances interest rates ceased to boost demand. A liquidity trap is quite simply the conditions in which interest rates no longer boost demand, and his explanation is the famous ex ante one, i.e. he said, to balance an economy, the intentions to save and the intention to invest must be equal. And if they don't, you have to push them. You have to put net investment, which is the net between investment intentions and savings intention. You have to bring that back into balance, or you will find that you have an unemployment which produces the balance, a very unpleasant way around. To stop unemployment causing the balance, you have therefore to boost either investment or cut savings. And the simplest way of doing that was to cut savings by running a budget deficit, because a budget deficit is an increase in the dis-savings, if you like, of the government. So what you have here is a liquidity trap being identified by Keynes with the assumption that it was a temporary effect, a solution for it, which would only work if it was a temporary effect. And what we now know is that liquidity traps can be structural, and therefore we need a third policy if we're going to deal with them. So then if I may, move to slide 20, which is my conclusions. The consensus model is wrong because its assumptions have led to wrong conclusions. We must discard it both for teaching theory and as a guide to policy. We must introduce tax policy as the third instrument. I submit that we can change teaching by replacing the consensus model with the stock market model, but we also need to take note of the problem of money supply. And as I mentioned, I can only produce a pragmatic approach to that because I have not yet found any monetarist or non-monetarist who's able to find a testable model for money, how it works. But nonetheless, it clearly does have a problem. And since we can avoid that problem, we must take a pragmatic attitude and avoid it, even if we do not yet know how the money works to cause this sort of delayed impact on inflation that we've clearly seen recently and has been part of the historic history of money and GDP. Thank you very much. I can stop for a moment, take a breath of water, and hope that somebody has been sufficiently interested to ask a question. Thank you.
Well, thank you very much, Andrew. I'm going to trust people to put their hands up or to take themselves off mute. Before we go any further, have you got any empirical evidence that there is independence of real returns between cash, bonds and equities? Professor Smithers.
Yes, indeed. Now, I hope that I've produced a slide to show this, and I will go to my own. Oh, here we are. That's right. Here, what I did just to illustrate this point, it's well-known point, nobody, if I ever know, has actually doubted that they do in practice behave in this way. It's just that if you point this out to consensus modelers, they just ignore it. Or I've had occasion to find people who say, but the data are wrong. Well, I can't think of any data less likely to be wrong than the history of share prices and dividends. They're not exactly historical data which is subject to wild, improbable invention by anybody. As you will see from this chart, what I've done here is taken the 220 years data we have, and I've shown that equities are mean reverting here on a 30-year term rather than a 1-year term, and that they just simply don't relate to either bonds or equities. I can also show that, in fact, bonds and cash don't relate to each other. You can test this by testing the long term of the difference between long-dated bonds and equities, and you will find that that has been on a long-term rising trend since the data which we've got, which goes back to about 1870, I think. Probably if they could take them longer, we could. They also we have them both. Thank you very much.
Well, you're in luck because you've got not one, not two, but 3 questions coming up. But the first of those questions, I'll take them in the order in which they arrived, is from Martin. Martin, do you want to take yourself off mute and ask the question directly?
Yes, this is Martin White. Thank you very much for this presentation, Andrew. I've been looking at your work for a long time, and I find it incredibly insightful as an actuary. One thing I'd like to raise is the fact that when asset prices go up, people often feel good about it, and politicians often feel good about it. But what comes through all this is that high asset prices are basically not a good thing, and they're intergenerationally nasty as well. How can we get the world to face up to this if it's true?
Oh, the question you're asking really is to me then is how do we change politics? Well, my answer to that is that I'm not a politician. I'm not an influencer. But my view is that we're not going to get politicians to change unless we can actually get economists to change. Basically, when politicians debate, they debate on the economic assumptions which are false. And they will continue then to be confused, as economists continue to be confused, until they straighten out the economic theory they're using. And basically, we've got to throw away the idea that interest rates, real interest rates, and equity returns and cost of capital move together. They don't. And the assumption that they do is fundamental to the current consensus theory, and frankly speaking, it is nonsense.
Thank you for that. Martin, do you want to come back? Are you happy for us to move on?
No, I think we should move on, but thank you very much, Andrew. I mean, we have the odd politician here. It'd be rather interesting to hear their thoughts.
Okay, I see a wry smile on one of the politicians' faces, so we'll perhaps come to that later. Paul, you've got your question ready, I hope. Do you want to take yourself off mute? Excellent.
Yeah. Excellent presentation, Andrew. Thank you. I can see that you pay a lot of respect to Robert Schiller's work, and it strikes me that to the previous.
Can you hear me?
Well, we've lost you for a moment.
Politics.
Hello? Hello, am I still on?
Can you hear me?
Yes, we can hear you now.
Good, okay. I don't know what happened. Yeah, okay. As long as you can hear, please continue.
So, okay, so to the previous point, yes, well, I guess we must agree that politicians are probably not going to change enormously given the short tenure that they have. But is there something else we can change? Can we change the mindset of those who control investments to be a little less farmer and a little more Schiller?
I don't think so. But I think we can use their incentives so that they become more willing to invest. A previous book that I wrote called Productivity and the Bonus Culture suggested that one of the reasons why there'd been such a sad drop in investment this century was because we had changed the incentives to investment. What happened was in the 1990s, there was a dramatic change in the way management is paid, and that dramatic change shifted the incentives away from investment towards buybacks and just doing nothing, if you like. No, we can change that back again, and I propose that we do that by giving tax credits on investment. If you give tax credits on investment and you do not make the mistake, which treasuries are so liable to make, to wishing to reduce the tax allowances on depreciation at the same time, if you do it without messing up with the depreciation allowances, then an increase in investment raises EPS. And since most bonuses are heavily tied to changes in EPS, we can change the present system, the one which discourages investment to one which encourages investment. And I think that would be a very simple change to be done. And all we need to do is say, in UK, for example, we currently spend 1.8% of our GDP on discouraging investment through the income on corporation tax. That is absolute folly. We could offset that quite simply by a 40% credit on all investment. And if we did that, I think we would quite clearly see, surprising that people assumed it would continue. We'd have to get the faith in there. It was a government policy which could continue for 5 years or so. If you did that, then you would get a very sharp increase in investment. And if you get an increase in investment, you get an increase in growth. Growth depends very much on the amount of investment, and it grows with the capital stock, and the capital stock rises with investment. Thank you.
Yeah, thanks for that. That's absolutely fascinating, and I must have positioned the question wrong because it wasn't what I was driving at. My question is really to those who control investment advice, be it wholesale or retail. And the question there is more to my concern is that overvaluations are ignored. And the justification for ignoring extreme valuations is that the price is always right, which is more to the farmer view than I think it is to the Schiller view. So I was thinking more to, can we change the minds of investment advisors a little bit towards Schiller and away from farmer?
I doubt it. When Stephen and I wrote our book called Valuing Wall Street, we also did a calculation which will vary over time because the data change over time. But what we showed was that when we came out with our book in March 2000, we said the market was about 70% overpriced. And we then said you would take a different decision if you were advising people or if you're running your own money. A 70% chance of the stock market falling in real terms that year is a 30% chance of being wrong if you are running money. The risks of being wrong compared with the risks of doing nothing are simply too high. Basically speaking, it was quite reasonable for investment managers and advisors to ignore the overvaluation of the stock market, because the benefit from getting it right, while high, was more than outweighed by the high risk of being wrong and ruining your business.
Thank you very much. I'm going to move on to Con. Would you like to unmute yourself, Con?
Yeah, thank you. Hi, Andrew. It's good to see you. A comment and a question. The comment is on the difficulty in terms of the analysis of monetary policy. Isn't the problem just that one needs to identify the regime in which we are active before trying to determine what the effects are likely to be? And the 2020 episode, I think, represents a classic natural experiment in which, with respect to that hypothesis, basically, for post-crisis, we saw 12 years or so, a long decade of monetary policy proving non-inflationary. That was basically because what we were trying to correct for at that point in time was a demand shortfall. Whereas after the advent of COVID, what we saw was, in fact, supply shortfall. And the response of loosening monetary policy and doing several $100 billion of quantitative easing resulted in precisely the huge inflationary impacts that we saw in the course of 2021 and right up until today, actually. That's the comment. What I also have, though, is a question. I wondered what your views were on the Mansion House Agreement and the proposals to relax investment objectives and other things for defined benefit pension schemes.
Well, two quite separate points. On the first one, all I am willing to say is that in the absence of a testable model for money supply's impact on the economy, I think it is rash for anybody to assume that they know exactly how it works. I would add, however, that a major fault, the one I mentioned Robin Maris back in 1959, I think, originally, pointing out that the consensus model assumed that behavior of companies and shareholders was tied to net worth, and that they both behaved in exactly the same way. There was no distinction between the household sector and the business sector. They all behaved in the same way. And he wrote that he thought there was almost certainly a difference in the utility functions of the people taking investment decisions, i.e. investing money in fixed capital, and people taking portfolio decisions, i.e. whether to hold bonds, cash, or equities. And I'm sure he was right. Now, my observation about the money supply people that I've read is that they actually do not make a distinction between the household and the business sector. And if they did, they might get more traction out of their analysis. That's just an aside. It's I haven't done it, and I can't say that I've said anybody who did, but it seems to me likely that variations in the cash holdings of share of companies and variations in the cash holdings of household sector have different impacts on the economy, and every monetarist I've ever read doesn't seem to bother with that, and I think that's a serious error. Now, on the questions you asked me about how companies and pension funds should raise, I think the debate here has been a pretty sad one. We have a serious problem, which is that households are not saving enough for getting a decent income in retirement, assuming that the economy grows. If the economy grows, you not only have to save enough to pay people in the future, shall we say, 2/3 of their, if there was no growth in the economy, either in people or income, and you worked for 40 years and you retired for 20, well, roughly speaking, you could give yourself a 50% pension by having I think it is a 15%, I can't remember the figures, reduction from your current income. But if you have a growing economy, whatever the figure is, and I'm sorry, I'm lasting on, whatever the figure is that you need to save more if you're going to grow into the future. And people at the moment are not saving enough. And the reason that they're not saving enough is twofold. One is that we've had the most appalling regulatory system, which has taught to assume that the returns on capital are linked to real rates of interest, which, as I said, they are not. So the assumed cost of pensions is overstated. And this has driven people away from having defined pension schemes to having defined benefit schemes, to having defined contribution schemes. And if you're going to have defined contribution schemes, you have to do something, which is to encourage people to take a very optimistic long-term view, because what happens in the short term is that you get into desperate trouble of assuming that you're not going to get much of a return, and you despair and you simply can't be bothered to save. If you're not going to get a decent return on your investment, you probably don't save. And we need a major change in the regulatory system, and we need, I think, if we can, to encourage the arrival of long-term saving schemes which are based on defined benefits. And to do that, you have to have schemes which amalgamate companies, because companies do not last forever. So you have too big a risk if you have company schemes to run defined benefit schemes. The things that have gone wrong with the pension schemes of the UK are threefold. The most important and serious one is the expectation of life on retirement has gone up from 10 years when I was around the 1960s looking at this to about 20 years now, which means anything else changes, you've got to double up the contribution rate. Secondly, you've got a huge increase in the stock market. So we are now getting low returns prospectively for current generation. We've got an intergenerational problem. And we've got the fact that companies do not last long enough to make a long-term bet on the stock market, a sensible thing for defined benefit schemes. We've got to try and address all those.
I've got a number of questions, so I'm going to move quickly on. Can you keep the questions short and hopefully the answers short too, so we can get to everybody? Next up, Jagit, would you? I've seen you've been commenting in the chat. Thanks for that. Can you ask your question?
Thank you, Henry, and thank you, Andrew. Always lovely to hear you. This is Jagjit Chadha. I'm afraid I've got my camera off because I'm travelling at the moment. very much agree with Andrew on the need for investment, and just want to pick that point up and point that towards what does that then mean for the second arm of public policy. There are many different types of budget deficits. There are budget deficits because even at full employment, there are large welfare demands and need for support for poorer families that leads to a deficit, or deficits because there's a large degree of public investment. You'll be very well aware that public investment over the last 40 years has been around half the level it was previously. I wonder what role that has played in this part of the second question, which is I really would rather interpret your statement about tax policy about the supply side. How do we improve the supply side of the economy? It's not just about tax policy per se, it's all kinds of different interventions we might have on the skills base, as well as infrastructure, which goes back to the point about public investment, as well as providing incentives for international firms to site in other parts of the country than the southeast of England. All of that creates local areas of demand. So my question is, how do we really affect the supply side in the way that you would like to see and bring about investment back up to levels that are appropriate with long-term growth? Thank you.
My answer, Jack, is very simple. I think that a great deal of debate about how to improve investment is counterproductive. All that happens is you ask people who don't know the answer for an answer, and you will no more get that than you would have got 18th century doctors being told, please tell us how to improve life expectancy. You get ego answers. People each have their own little pet bet, and they wish to air that. And there is no serious. The answer to getting investment up and growth up is simple. Subsidize investment. It is as simple as that. And if we took that point, we would get it up. I think that the other points are largely irrelevant. I don't know how fast the economy will grow or invest anyway, but I do know that if you subsidize investment, it will grow faster than it otherwise would have done.
Thanks very much. I'm going to move on to Jonathan. You've got a question. Do you want to take us off of mute? Thank you.
Yes, hello, Andrew. I read The Economics of the Stock Market, and fascinating book. I'm still digesting the theory and the ideas in it. It struck me, though, that one of the core facets, core features you're trying to explain is this invariance of stock market returns. That over 30 years, stock market returns tend to be the same. And as you pointed out today, you get wide variations in the real returns from other assets. And it rather struck me as perhaps being similar to the theory of relativity, where Einstein said, look, what if the speed of light in a vacuum is a constant? What are all the ramifications of that? So my question is really, am I on the right lines in understanding the theory to say, look, this is the starting principle for a lot of the ideas in the economics of the stock market? How do we explain this? How do all the other variables fit in with this phenomenon that you've observed?
The answer, Jonathan, is yes. You've hit the key point. Instead of making a bad assumption about the cost of capital and the way in which equity impacts on investment, we should make the assumption, which I do, which is that equity returns are mean reverting. And secondly, what follows obviously from that, what determines the level of investment is the expected return on the equity needed to finance it. And that expected return, if it's above 6.7, you get investment more, and if it's below, you get investment down. And therefore, and I found that in doing that and making both our assumptions, we have an extremely tractable model. The model which I set out in the economics of the stock market is staggeringly tractable. I believe that if people in academia stop messing around with the wrong assumptions and applied their mind to the point that you've made, which is that equity returns are mean reverting, if they applied their mind to that, they would have an immense, we'd suddenly have a revolution in economics. The progress would be tremendous and it would be excellent.
Thank you very much. Are you okay if I move on, Jonathan?
Yes, thank you.
Okay. Lord Lilly, I assume it's Peter. Do you want to call for the question? Yeah.
Yes, thank you. I agree that lack of investment is the chronic weakness of the British economy. Andrew, if increasing the tax burden on investment doesn't diminish it, why should subsidizing investment increase it? If it's because the subsidies relate to future investment and the tax applies to all the past, why don't 100% allowances with a high rate of tax work better than our previous rate of taxing over the lifetime of assets and at a lower rate? Whenever I tell people, oh, look, my friend Andrew Smithers tells me that rate of tax doesn't affect investment, they say, well, what about Ireland? So those are my questions.
But Ireland is a very good example. Ireland has the lowest corporation tax, as far as I can say, in Europe, and the fastest growth. I disagree with
They have lots of investment.
They have lots of investment. They have low corporation tax, high investment. So we unfortunately.
I thought you said corporation tax is irrelevant.
Corporation tax is irrelevant to the return, but it's a tax on investment. So people reduce when corporation tax goes up, people reduce investment. Hence, what happened in 1997, Gordon Brown doubled the rate of corporation tax by abolishing ACT, and investment fell like a stone.
I'm going to apologise to William for missing him out and ignoring you for too long. William, would you like to ask your question? You have to come off mute.
Yeah.
All right.
No.
Welcome to the meeting. Are you there, William?
Yeah. Can you hear me now?
We can hear you now, yes.
Okay, super. Andrew, as usual,
hello.
a great pleasure. I guess my question is, looking forward and recognizing the current problems that we have, particularly of debt overhang, what policy recommendations would be made by your model, the stock market model, as opposed to those that would come out of the conventional theory?
Oh, okay, Bill. The answer at the moment is that conventional theory produces only a mess. Conventional theory doesn't have a satisfactory growth model. I put this in my last book. It doesn't have a satisfactory growth model because it assumes something which isn't true. It assumes that investment rises and falls with short-term interest rates, which it doesn't. So my answer is very simple. If you use the stock market model, you will understand why investment goes up and down. And if you do that, you will then find that cutting corporation tax or subsidizing investment will increase growth. Am I being clear, Bill?
Yes.
Thank you very much. Carry on. Carry on. Carry on, Will.
Oh, my question is, looking forward, certainly we do need more investment for all sorts of reasons. I've been very much of the view that many of the positive shocks in the past are going to turn into negative supply shocks in the future. Investment is the answer. How would you intend to deal with the overhang of debt problem and the consequences the higher interest rates that might be required in that environment and the overhang of debt?
Well, if we subsidize investment, we will find that a higher proportion of corporate profits is shifted from savings, from spending to investment. At the moment, I don't know what it is in various countries, but a high proportion of corporate profits now gets paid back to shareholders either through buybacks or dividends. I should think it's probably 70, 80, 90%. If you get higher growth, and one of the things that I show in the economics of the stock market is that there is a strong correlation between growth and profit retentions. A great deal of the savings that we need to finance investment will simply come from a shift in the way companies distribute money. They will distribute less money, they will invest more. So you will get, I think, a higher rate of interest than you would otherwise. But you will get a higher rate of interest will actually make it easier to manage the economy. Because at the moment, you're in a liquidity trap where interest rates can't control demand. We need a higher rate of interest for making monetary policy tractable, usable. So point one is we get an awful lot of the savings needed to finance the increase in investment come out of corporations. They save it on behalf of shareholders. Secondly, yes, you get interest rates up, but that is a good thing because it's going to make the economy much more manageable. And what else? That I think is my answer. Any more?
I'm going to cut you short now, William, because we've got two people we want to fit in and we are actually pretty well out of time. So, Eugene, do you want to ask your question quickly because you've been waiting, and then I'll take a question from Bob as a pension stalwart.
First, I would like to say that the advisor, I'm one of the advisors, invest money for the clients. We are missing a method to time the market. There is no such method that Shiller came up with. Nobody has any method. In the absence of a model, we can only tell the clients to stay invested and not time the market. No model that shows successfully, we don't have anything else to teach our clients. This is how we go about. And secondly, this issue about assumptions, bad assumptions, good assumptions, they don't exist. There are only your assumptions. The future will show if the assumptions are good or bad. So now, yesterday, for example, Tesla has come up with an AI model and they build an AI computer, for example, to self-drive cars based on what they get from the drivers now. That's something that could be sold in the future. The Tesla stock went 10% up. I do not have a method, and nobody has a method to measure the future earnings on that thing and say if this is valued at 10% increase in stock price for Tesla. Investors, they come up with this number, 10%, and they put the stock by 10%. But again, there is no bad assumptions and very smart assumptions. There are only your assumptions.
Okay, I did ask you to be quick, Eugene.
Okay, right. Let me answer first. On the first point, you can't time the market. I agree. And I already made this point.
Thank you.
I already made this point when I said this is why investment managers are no use to advisors about timing the market. And when I wrote a paper with Stephen Wright on this called The Economic Constancies of Alan Greenspan, I said you can use investment advisors if you want to, but you can't use them to advise you on asset allocation. They have a bias to protect their own interests. Their interests are not the same as yours. Don't bother with them. The second point you make is irrelevant. The question of whether individual investment has a high return or not, or what it does to change, doesn't impact the return on equity. The return on equity is stable. It's mean reverting.
That's not true. It's variable all the time.
No, Eugene, let me put it this way. I assume that the return on equity is mean reverting.
That's your assumption. That is a good or a bad assumption we'll have to see for the next 10 years.
Okay, no, then do you miss the point? All I say is that it's mean reverting and the evidence is strongly in favor of it. And I've shown you the evidence. You can deny it. People love denying the truth.
No, it's not about. It's about that discounting future earnings from the next 10 years. And you don't know the future earnings in the 10 years.
I'm moderating here, Eugene, because in the interest of time, it's only fair that Bob gets to ask his question.
I stopped now.
Okay. Thank you. Bob.
Yeah, thank you, Henry. Andrew, thank you very, very much. Excellent presentation. I've read the book. I think the economics of the stock market should be read by the people at TPR who are building or trying to create the DB funding code. My background in pensions is questioning, does the fact that the UK government has massive debt loaded up with the civil service pension scheme and the unfunded public sector pension schemes, my real question is, are you, as you're not a politician, has your book been seen by the Treasury, and are the Treasury taking on board the implications of the fact that the standard model that's been operating for 30, 40, 50 years or so is wrong, and that you've got a model in the book which actually could help actually sort some of the problems that we're actually facing currently? Is Treasury actually taking on board what you're actually saying, Andrew?
My conversations with the Treasury lead me to say that the answer to that is no. Treasury officials, if they have an economic training, have been trained in nonsense. It is not their fault. It is not the fault, hence the purpose of this talk. It is not the fault of those who manage the economy that they manage it badly. It's the fault of what they were taught. You can't blame people for it. You can't blame the ignorant for their ignorance. What we need to do is to change the teaching of economics. And until we do that, we will get an incompetent Treasury and an incompetent Bank of England. It's not their fault.
I'll make one final point. I think your book has major ramifications for CDC schemes. So I think it's absolutely vital that CDC does get off the stock of legislation and actually starts to actually happen. It's the only way forward for UK pension schemes, unfortunately. Thank you. Thank you, Andrew.
I'm going to wrap things up now because we're well past the witching hour. But thanks to everyone who stayed on the call, and almost everyone has. It's been a fabulous hour, a real privilege to listen to the debate, and in particular to what Andrew's had to say. I'm going to hand back to Steve now, unless Andrew wants to say something in conclusion.
I would like to say one thing.
Okay.
If anybody has a question, I pride myself that I'm good on answering email questions. So if you have a question which you failed to ask, either because you were cut out because I answered the questions too much time, or because you haven't thought of the time, please email me with your question.
Could you give us your email? Andrew, could you give us your email?
Andrew@smithers.co.uk.
That's pretty good.
Can we have the slides, please?
Yes, of course.
Yes, we will circulate the slides. If you go on my blog, they'll be on it, and also a recording of this conversation will also be posted on that blog. The blog is henrytapp.com, and I will try and make sure that everyone on this call gets it. Is that okay? If you've got Peter Lilly's address, you might want to email the slides directly. Okay.
Yeah, okay, that's fine. Excellent. Andrew, that's fantastic. We've had some very, very positive comments. That was a very, very intuitive and amazing presentation, really. You know, we wish you well with your future papers and future books and future you know, direction of travel to try and change things. You know, it sounds like we've got to change it from the root up. So change the teaching, that will change the students, that will change, you know, the longer term investment training going forward. So it's really, very interesting. So thank you very much indeed for that. And thank you to Henry as well. Thanks everybody for your questions. Next week, we'll have anti-scamming, I think a presentation from Broadstone on anti-scamming. And if you would like to view this video, it'll be on the Pension Playpen website this afternoon, and also on Henry's blog. So check out either Henry's blog or the Pension Playpen website. If you're not a member of Playpen, please join. If you are a member of Playpen, please share with friends, and we'd love to have you on board. And as we always say on these presentations, let's pray and continue to pray for peace in the East. But Andrew, that was fantastic. I really appreciate everybody joining today's presentation, which I hope you enjoyed. And hopefully we'll see you next week on the next Pension Playpen Coffee Morning. But Andrew, that was fantastic, and really appreciate everybody's questions, and enjoy the rest of your day. And thanks for everybody's input. Absolutely brilliant. So regards to everyone. Everybody. Take care. Thanks a lot.
Yes.
Be good.
Thank you very much, Andrew. Thank you, everyone.
Bye.